This screencast is about the difference between calculating economic profit and accounting profit. Here are some different formulas that you're going to need to know in order to be able to answer these kind of questions. You could find these questions as multiple choice questions, or these could be great FRQs. So when you're looking at a few things, one, you have to know how to calculate total revenue. And total revenue is going to be calculated by price times quantity. You're also looking at total cost, which we've talked about before as being your fixed costs and your variable costs. But when you're asked to look at the difference between economic profit and accounting profit, you need to think about total cost as being about the difference between explicit and implicit costs. Remember that explicit costs are tangible items, things that you can buy. Those usually relate to land, labor, and capital. Implicit costs are really things that come from within, your next best alternatives, your opportunity costs when you're looking at things. And so when we're calculating profit, the formula for profit is total revenue minus total cost. A positive answer gives you a profit, a negative answer gives you a loss. When you're asked to distinguish between the accounting profit and the economic profit, we're going to take that total cost and we're going to explain it a little further. It's total revenue minus the explicit costs, and these are the things dealing with land, labor, and capital. Really, what separates the difference between accountants and profits is how you calculate the total costs. Because economists not only look at the tangible things that you've bought, but then they also think about the foregone wages, those opportunity costs that come with making that decision to go into this business. And so what was the next best job that you could have had? Because that would be your foregone wages. Another one that's used is the implicit cost of capital. So what would be a best alternative for using that capital? What's the money lost from that? And usually the foregone wages are the one that gets used the most when you're adding up the economic profit. So obviously we're adding in more things to the cost for the economist, and so that is why the accounting profit is usually more than the economic profit. But don't you think it's better to kind of think about everything instead of just the actual things where you're having to give money for it? This allows you really to make the best decision. So in this next example here, this is taken from Module 52 at the end where it asks you to tackle the free response questions. This is the FRQ number 2 from the book. And they give you this information about Sunny's snow cone stand for January. And they tell you that the price of the snow cones is $2. They sell 2,000 of them in January. They have explicit costs of $400. They have depreciation of $100. And they have implicit cost of capital of $200. Remember that when you're answering an FRQ, you need to respond in the way that the problem was set up. And so they ask you questions A, B, C, and D. And when you are answering the questions, you should start by putting your A for where you're going to put all of the information for it. When you're answering an FRQ, don't just tell what, tell why. So explain how you come to the answers that you have. You can't use a calculator, and so that way showing your work in case if you make a math problem, at least they'd give you some credit for getting the problem set up right, even if you come up with the wrong answer. So for part A, it asks you to calculate Sunny's snow cone stand total revenue for January. If you're looking at how you would want to respond to this as best as possible, you first give the formula for total revenue, and that is price times quantity. And then after that, you plug in your numbers where it tells you $2 for the price of a snow cone. They sell 2,000 of them, and so their total revenue is $4,000. The next question asks you to calculate the Sunny snow cone stand's accounting profits for January. So again, the formula for profit is total revenue minus total cost. The fact that it says accounting profit means that we're just thinking about those explicit costs. And so we've already calculated total revenue of $4,000, and now we need to look at the explicit costs. And in this case here, it is given to you with explicit costs, and then depreciation, which means the how the value of the capital is going down. You can think of depreciation too, like with your car, right? They always say when you drive it off the lot, it loses value. Well, the same thing here is true for capital when you use it over and over. And so you add up the explicit and the depreciation, and it tells you that the accounting profits are $3,500. So if they're doing their books and they're looking at, okay, this is how much the snow cones cost me, and these are the explicit costs for labor, the resources, the electricity, even your fixed costs that go into it, your rent, and any insurance or anything else that you need, that kind of stuff is calculated in there along with the depreciation. But then the next question says, well, what additional information would you need in order to continue operating the snow cone stand? This is basically coming down to now looking at the economic profit, because that determines if a firm should stay in business or if they should shut down and produce nothing in the short run, or even in the long run, totally get out of business. And in this case here, things that you need to think about that they gave you are anything implicit, which for here is just about the implicit cost of capital. Other things that could have been given were that instead of operating the sunny snow cone stand, this person could have had a job doing something else, and maybe they would have earned, $3,000 a month. And so that could be something that you could calculate in here. But they only give you one bit of information. So what additional information would he need in order to continuing to decide? It would have to be about the opportunity costs involved with running this business. And so explain how he would determine whether or not he could operate it. And so if you're looking at it here, you would use those economic profits, which would then be about the explicit and the implicit costs when you're calculating the total costs. So again, total revenue was $4,000. We had already put in those explicit costs, but then you add in the implicit costs of capital, what else that capital could have been used for, and that gives you this economic profit of $3,300. As long as your economic profit is either zero or above, then that means that business should stay in business. Remember that if it's zero, it's not that they're not earning any profit, they're earning just that normal profit. And that, again, would be taking into account those wages that they could have earned at a different job. That's your normal profit. And so that's how you know you're meeting that. So anytime you have a positive economic profit or an economic profit of zero, they should stay in business.